Recessions. These are not fun things to go through. Technically speaking, it's 2 quarters of negative GDP growth, but in reality, markets crash, people lose their jobs, sometimes even their homes, businesses fail, and incomes fall. However, this doesn't have to be you. While they're not avoidable, there are actions that you can take to mitigate the negative impact of the next recession and actually put you in a financial position to come out ahead. In this video, I'll walk through my recession strategy guide, explaining exactly how to prepare for the next market crash. If you're new here, my name is Michael, and take a second to subscribe to gain access to more investment content like this in the future. So the first recession strategy you want to have is to build a cash emergency fund. Now, having cash savings or an emergency fund is actually fairly common advice, but it's extremely important if you want to come out the other side of a recession in one piece. The reason for this is, contrary to popular belief, most people don't go bankrupt from having too much debt, they go bankrupt from having too little cash. Of course, having a lot of debt doesn't help, but as long as you're able to meet the minimum payments on your debt servicing, you won't be at risk of losing your assets, for instance your home, as long as you can keep making those mortgage payments with the cash that you have in reserve. In addition, the larger your cash reserve or larger your emergency fund is, you have more optionality. This is beneficial for several reasons. For instance, as the name implies, if an emergency does come up, you'll have the cash on hand to be able to resolve the issue. Even more so in the context of a recession where it's possible or a higher risk of you potentially losing your job or seeing a decrease in income, an emergency fund allows and provides the flexibility to not be forced to take that first job offer if you think you can do better. Having cash reserves to pay your expenses when you're not having income coming in allows you to find the right job, not necessarily just the next job. You can do all this without having to sell your things or assets at depressed prices, which usually occur during these recessions. During recessions, it's the worst time to sell assets, and it's the best time to have cash, which is why an emergency fund is so important. So we've established the importance of an emergency fund, but the next question is, how much cash should we actually have? Well, the answer will depend on your personal financial situation, but most people should have at a bare minimum 1 month of expenses in cash, and ideally have roughly 3 to 6 months in cash put away in an emergency fund. If you're very conservative or have income that fluctuates or is very dependent on economic cycles, for instance, let's say like a real estate agent, then you might want to have more cash on hand, potentially up to a year's worth of expenses to provide you greater financial security. Now, I recently read an article that over 75% of Americans are still living paycheck to paycheck. So if you don't have at least 1 month of expenses saved up in cash, make this a priority for yourself for this year. Once you have this amount saved up, don't just hold it in cash, but put it in a high yield savings account or a money market fund. There are many online savings accounts that are FDIC insured and pay a relatively competitive rate of interest. In addition, some money market funds offered through brokerages can offer a higher rate of interest than savings accounts, but keep in mind it's not FDIC insured. Personally, I use a combination of a high yield savings account with Ally and have the majority of my cash reserves in the Vanguard Prime Money Market Fund with Vanguard. Again, having a cash emergency fund is the rock or the foundation that will keep you afloat during a recession and is something that everyone should have. The second step to the recession strategy guide is to pay down your debts. Having debt, especially high levels of debt or debt with high interest rates, puts you in a much weaker financial position. The greater those debts or interest payments, the greater proportion of your income that comes in that has to go to servicing these debts. This leaves you with less money or capital to buy assets at depressed prices, which can occur during a recession. And even worse, if you're unable to pay or service your debts, you'll be forced to sell your own assets, often at depressed prices. This is an extremely wealth destructive process, and it's something you want to avoid at all costs. For example, during the financial crisis in 2008, many people lost their income and unfortunately were living paycheck to paycheck. So when they didn't have the income to service their mortgages, they ended up being forced to sell their house at a very suboptimal time. Unfortunately, this is a reality that could occur if you don't have enough cash and your debt levels are simply too high. So when it comes to paying down debt, what is the optimal strategy you want to take? Now, you may have heard several strategies regarding this topic, but mathematically, the one that is most optimal and will save you the most amount of interest paid is to pay down your highest interest debt first and pay it down completely, and then after that, move to the next highest interest rate. If you focus on paying your highest interest rate debt first and make minimum payments on all your other debts, this will save you the most money over time. An alternative strategy is to pay your debt with the smallest balance first. However, this will end up costing you more interest over time. Now, some will argue it's more of a psychological boost to see these small balances being paid off completely. But if you want to get serious and smart about paying off your debt, you'll start with the highest interest rate first. Now, when it comes to quote-unquote high interest rate debt, what exactly does that mean? Again, you'll often find a lot of debate on what constitutes a high interest rate, but in my view, any debt that you have that has an interest rate of over 6% is debt that you should really prioritize paying down above everything else, and that includes investing. The reason that you probably want to focus on paying down your high or above 6% interest debt first is because by paying down that debt, you're getting 6% rate of return risk-free because you'll no longer have to pay interest on that debt that you paid down. The argument for generally trying to invest even when you have debt is that if you can make above the interest rate on your debt, then you'll end up ahead in the long term. However, if we're thinking about things in the context of a recession, this is a high-risk proposition. Let's say instead of paying down 6% interest debt, you're able to average an 8% return in the stock market. It seems like you're doing pretty well on getting ahead. Unfortunately, the reality is you're only really making about 2% in that case, because from your 8% returns in the stock market, you still have to take away 6% from the interest on the debt that you didn't pay down. All this while taking all of the risk of a significant drop in the stock market should we see a recession. There's much less financial risk for you when you pay down these high interest debts, and I personally never met anyone who regretted being debt-free. Now, if you have other debts with interest rates of 6% or less, I would still likely recommend paying off any non-mortgage debt that you have. Now, whether or not you want to decide to pay that off or invest the difference, that's up to you, but just keep in mind that you will have less financial risk if you have lower debt. Now, I should note, if you have high interest debts, you should make this a priority even before fully filling up your emergency fund. I'd still recommend having at least 1 month of expenses, and you can go up to 3, but any more than that, you're really leaving money on the table by not using that cash instead to pay down this high interest debt. So just by these 2 steps alone, having a cash emergency fund and really focusing on paying down your debts, you are already going to be better prepared for a recession than 90% of people. But to take things even a step further, the third recession strategy is to reduce your current level of spending. Now, this doesn't mean becoming an extreme cheapskate and reusing toilet paper, but you should take a reasonable look at your spending habits and see if there's room for optimization or improvement in the future. Reducing your expenses is actually a very financially powerful tool because every dollar saved is actually more valuable than a dollar earned. And this is because you don't have to pay taxes on the dollar you save by reducing your expenses. Now, if you don't track your expenses, that's something I highly recommend you do. And I have a neat spreadsheet in the description below which can help you do that, but there's a variety and multitude of free available options online which can help you do the same thing as well. But to get started, you can take a look at several of your most recent credit card and bank statements to take a look of where your itemized spending is actually going each month. This is not by any means an exhaustive list, but we can hit a few areas for potential quick improvements. Housing and transportation are likely 2 of the biggest expense categories for most people. While you might not be able to implement these right away, you can ask yourself, if you're potentially planning to move in the future, how much space do you really realistically need? Keep in mind, bigger isn't always better, especially when you have to pay rent on all those square feet that you don't actually really use. For transportation, there's a lot of different ways to save money, but probably the biggest one I would say is to try and not buy a car new, because when you do, you lose a lot of the value almost immediately through depreciation. Instead, buy a used car of a reliable model in cash and drive it as long as you can. This will help lower the average cost per mile of the car, and that savings will go directly to your bank account. As for food, take a look at realistically how much or how often you eat out, and see if you can transition a greater proportion of those meals to meals that you prepare at home, oftentimes for a fraction of the cost. For entertainment, take a look at your subscription services. Cable television is often a big one, and see if you can do without or a cheaper cost option. As for energy, if you're still using incandescent bulbs, definitely consider switching to LED, as if you're using that bulb, let's say 2 hours a day, that bulb will pay for itself in less than a year. In addition, if you're able to keep your home slightly cooler in the winter and slightly warmer in the summer, you can save a substantial amount on heating and cooling bills during each of those months. And finally, if you have a self-storage unit, definitely consider trying to sell, donate, or simply just get rid of some of that extra stuff, because oftentimes the cost you're paying per square foot of those storage facilities is likely a higher rate than what you're paying for your current rent. Personally, I use my own spreadsheet and track every penny that I spend and earn, and every few months I take a look and see if there are areas I can optimize even further. Taking the time to analyze and reduce your spending now will give you extra cash flow that you can use to accelerate your building of your cash emergency fund and paying off your debts. So if you've completed the first 3 steps, you're putting yourself in a great financial position and can move on to the 4th strategy, which is to invest any extra cash you have beyond that. So assuming you have a fully funded emergency fund, paid off all of your non-mortgage debts, and have reduced your spending, it's time to start putting that extra capital to work and investing it. First things first, make sure you're getting the full employer match on your 401k contributions. Some people call getting your 401k match free money, but in reality, it's not free money at all. It's simply part of your benefits. By not taking full advantage of the employer match or contributing at a rate below that which doesn't give you the full employer match, you are voluntarily taking a pay cut for nothing in return. In a rational world, surely no one would take a pay cut for free, but in the context of 401k matching, it's surprisingly common. Make sure it's not you and you get your full match this year. Okay, so the question now is, how do we actually invest the money that we have? And there are several options, and these are not all or nothing options, and you can do a combination of them. One option would be to invest in safer assets like fixed income, which would be your cash savings, money market funds, and some bonds. In a recession, we'd likely and most often see market crashes within the stock market, where assets like stocks are trading at depressed prices much lower than they have been in years past. Now, while this is not something you can predict, having an opportunity fund allows you to hold this capital, which can then be used to buy higher return assets at lower prices in the future. During the financial crisis, this was a huge opportunity for people who had these funds available, and even as recently as December 2018. In those cases, having at least some cash in an opportunity fund like this can be prudent to give you the opportunity to buy assets at relatively cheap prices. Another option is long-term investments in stocks, which is really you investing in businesses. Broad index ETFs or exchange-traded funds are one very effective option for doing this. In the case of a single S&P 500 index fund, you can get broad diversification by investing in the top 500 companies in the United States. This is how most people start investing. For many people, this will work just fine. The Vanguard S&P 500 ETF, ticker symbol VOO, and the Vanguard Total Stock Market ETF, ticker symbol VTI, are 2 good starting points for most people. The key is to look for low fees in terms of a low expense ratio. The expense ratio is the percent of assets in the fund that are used each year to cover the cost of managing the fund. Expense ratios directly take away from the returns from your investment, so you want these as low as possible. One advantage of index fund ETFs is that they have extremely long longevity. You won't have to worry about picking individual stocks or the index going bankrupt. In addition, you won't have to worry about missing out on the next Amazon or future investment trends, because that will often be included within the index. However, one caveat with index funds is that you will have to accept the volatility that the market brings. And oftentimes, this is much more volatility than many investors are really expecting. The price of these index funds could drop by 10% in a month or even by 50% in a year. Now, this is relatively rare, but it's certainly a possibility. You have to have strong mental fortitude during a recession and a market crash to hold on to your investments and not panic sell, even if the price of these index funds continues to fall in the short term. Simply buying and then holding for the long term is one of the best strategies for index fund investing because it helps remove the emotional errors that can occur. And aside from investing in the index, you can also invest specifically in individual businesses and stocks. This would be if you're a more enterprising investor and are specifically interested in learning a bit more about business and security analysis. But before you start investing in individual stocks, you want to build an investment framework that helps guide your decision-making process when investing in these companies. And I've already done a detailed video of that, which will be in the description below. Additionally, you'll want to know how to value these stocks and determine a buying strategy that'll be used to enter into these positions. I have another separate video on that, which again will be linked in the description below. Now, logistically speaking, across all of those different methods, one of the best ways to help allocate your cash and capital over time is a simple strategy called dollar cost averaging. Dollar cost averaging, or DCA for short, is effectively investing the same amount of money each and every month or each and every quarter, whatever your time period is that you're setting. The key is to determine the dollar amount and frequency ahead of time and then stick to the schedule regardless of market movements. When markets are up, you'll be buying proportionally fewer shares than compared to when markets are down, where your money will go further and buy more shares. This is a natural and systematic way to buy less when prices are high and buy more when prices are low. Doing all of this will allow you to be in the position to continue buying cheap assets at depressed prices during the next recession. Now, the first four strategies are more than adequate on their own, but I don't think a discussion on recession strategies would be complete without the fifth strategy, which is hedges. Hedges are generally smaller bets or positions within your portfolio that are designed to act differently than the rest of the portfolio. For example, if your main stock investments fall during a market crash, which could occur during a recession, a hedge might potentially increase in price during that time, reducing the overall portfolio drawdown. Hedges don't have to be all that complicated either. One of the most common hedges you can implement is simply holding more cash in your opportunity fund. Having this extra cash can allow you to take greater advantage of market declines when they do occur. The flip side is that, like most hedges, there is an opportunity cost for having the hedge. In the case of cash, the interest generated on that cash will only barely keep up with inflation, so it would be beneficial to invest your extra cash, again the cash outside of your emergency fund, at some point in the future. Another common hedge is gold. Long-term, gold is a relatively good hedge against potential higher rates of inflation, and in the short term, it's a good hedge against market panic or volatility. The idea behind gold as a long-term hedge is relatively straightforward. As central banks around the world are printing more and more money, this eventually at some point will likely lead to inflation. We haven't really seen that as much within consumer prices, except in some sectors of the market. But what we have seen is significant asset price inflation in the price of both stocks and bonds, and in many markets around the world, leading to negative interest rates. Long term, these trends will likely support a higher fundamental price for gold. However, on the flip side, in the short term, the price of gold will be very volatile and might not hedge exactly as you expect it to. Though over the long term, when we're talking about 15, 20 years from now, I do think gold will likely be a better hedge than cash. If you're interested in further discussion on gold, there'll be a link to the video of that in the description below. Another potential hedge is using options, specifically buying a type of derivative called a put option. Put options are a bet that a certain stock or index will be below a specific price on a certain date. If the price of that stock or index goes down below the stake price of the put option, then you, as the owner of the put option, will get a payout. If the price of the stock or index is just 1 cent above the stake price at expiration, then you lose all of the money that you put into that put option. Generally speaking, for most cases, buying puts is a relatively expensive form of insurance on a stock position. Generally, I recommend most new investors stay away from options because of their high cost and high risk, and also the potential need to renew these put options if you want to continue having a hedge on your position. If you have a long-term portfolio with a long-term mindset, you shouldn't need put options and should be able to weather the short-term volatility. However, for some people in certain instances who need a very specific hedge over a given time period, options can be one way to achieve that. Overall, if you're looking to help smooth out the volatility within your portfolio, even for the long term, hedges can be potentially one way for you to achieve that, to help minimize the overall drawdown of your portfolio during volatile periods in time, like during a recession. The last strategy I have for you isn't a financial strategy, but is one that I think has just as big a financial impact. That is to control your emotions during a recession and not the other way around. If you've completed all the previous recession strategies and steps, you're already in a fantastic position. Don't jeopardize that with emotional mistakes. This is when you end up selling your investments, typically an emotionally driven decision on a day when the markets are down quite significantly. The rationale behind this is that you don't want to lose any more than you already have. The way our brains work, this is a very strong impulse to try and avoid losses. Unfortunately, however, this is also a very short-term mindset, and in the long term, this is the exact opposite of what you want to be doing. So during the next recession and market crash, don't be afraid to buy, and to implement this, stick with a system that you know can work, like dollar cost averaging, to make sure you're continuously investing and buying assets cheap while you can. Overall, you're not going to be able to predict the next recession. However, that doesn't mean there's no benefit in preparing for it. By following these 6 steps, you'll be able to not worry as much during the next recession and be in a financial position where you can actually benefit coming out of it. When you see headlines from great investors like Ray Dalio saying the market is broken and the world has gone mad with cheap money, Michael Burry saying that index investing is actually in a bubble, and Warren Buffett is holding record levels of cash. These are all headlines that make you want to pause and take stock of where we really are in the markets. Now, I'm not smart enough to tell you exactly when the next recession will be, and to be honest, No one is. But what I can tell you is that when it does occur, I'll be ready. And hopefully after watching this video, many of you can be too. I hope you enjoyed this video and got a lot of value out of it. And until next time, thank you so much for watching. My name is Michael, and I will see you in the next video.